America. So let's bring Doug into this conversation. Douglas, we are in a situation where fiscal policy is more than overfilling the output hole that has been left by the pandemic. That money is going to spill out. You are worried. I read in your notes, there's no question. It says the 1.9 trillion, the rescue plan, far exceeds any sensible macroeconomic stimulus. When are we going to know? When are we going to know whether this is going to produce transitory inflation or something more sustained?
Well, I first want to agree with Claudia on the impact of the service sector. That is the depressed sector because of the coronavirus. And as we defeat the virus, people return to hotels, restaurants, and the general leisure and hospitality sector. Those depressed prices are going to go up. And we'll see a transitory piece of inflation out of that no matter what. And that'll be a good news piece of inflation. The second thing we'll see is this stimulus package hit, and it will flow into the economy and overheat. But I don't think it will generate sustained consumer price inflation. I know, for example, former Treasury Secretary Larry Summers is very concerned about that. I don't think that's the big risk. It takes a lot to generate the kind of inflation that the United States and other countries experienced in the late 60s and 70s. You have to run the economy way overheated for a long time. We did it for 6 years in the late 60s. It was above potential. We got sustained inflation. This is way too big, but it's transitory. And so I think what is most likely to happen is that the money's going to hit. We're still not going to be completely opened up. We're going to be fighting variants of the virus. We're going to be still have cases rising in the U.S. in some states. Money will flow into savings accounts. We've seen this before. Savings rate hit 20% after the checks in December. And then it's going to start looking for some place that has a better yield. And what I expect to have happen is asset price inflation. And that, I think, is the risk this runs, that you see a spike in some asset prices. You see the Fed trying to figure out whether they have a financial stability problem. Do they need to move? Do they need to remove excess liquidity? Are they going to have to think about moving rates faster than they've promised markets? That's the risk. And that could be a real headwind going into the second half of this year.
Doug, on that note, you hear Claudia mention the bond market. And explain to me, because I get a little confused, how do we have a Fed that wants higher inflation but doesn't want higher long-end yields, i.e. higher, tighter financial conditions?
Well, it can't have everything simultaneously. And I think they've done a good job at focusing on the real economy, using the labor market as the primary indicator of the health of the real economy. But in doing so, they run the risk of repeating what has been the 21st century bane for the Fed, and that is some sort of financial instability that produces bad fallout for the real economy. Happened with the dot-com bubble, happened with the credit bubble. If they focus on the real economy and only worry about the unemployment rate, I think they run the risk of letting asset markets get out of hand again. They step in abruptly, and you get bad fallout. That's the risk that we have in the moment.
How do they make that transition work? Claudia thinks they can make that transition work. Can they make it work in your mind? Because going from super low interest rates to normal interest rates without a taper tantrum looks like a really big ask. Just briefly, if you could.
So I think it's true they've learned their lesson about consumer price inflation, but they haven't brought into the conversation the importance of financial stability and the trade-off between low unemployment and the potential for financial instability. They need to talk about that. They need to comfort markets that they're not concerned about the pricing and the pricing is accurate and consistent with the expectations. There needs to be a lot more communication on that front. They're talking about inflation and unemployment, missing the financial markets.
Okay, guys, we're going to wrap it up there. Thank you so much for your time today and your insight. Claudia Sahm, former Federal Reserve economist and Bloomberg opinion contributor. Douglas Holtz-Eakin, American Action Forum president and former director of the CBO. Up next,